All right, I want to quickly make another video about another trade that I use to hedge the downside in low volatility. Like we kind of talked about in the previous video, when volatility is low, we know that it's going to go back up at some point. We just don't know when. But we know that it's going to go back up, which means the market's going to go down. So at the same time, this trade with market being at all-time highs, there's a likelihood that you see a pullback at some point. And if you're smart, you're going to be long the market when it's going up. So your beta weighted delta of the overall portfolio should be positive. Like it should be a positive delta. Like you make money as the market grinds higher. Okay. So you need to hedge your downside. You need something to spread downside risk. And this trade is one of them. And it also works with vol. So I figured I show you guys. Now you can do this with XSP, or you can do this with SPY. With SPY, you have assignment risk. XSP, you don't. It's cash settled. So that's just something to know. You also can do it with SPX if you have a really huge account. But anyway, in SPY, we'll just build it in here in SPY. So how this usually works is I go out. So like for this month, the monthly expiration's here, 6 days, whatever. It's not really usable. I go out to September, and I will sell in out of the money put. It, you can. I'll show you. You can skew these kind of based on your bias, but let's just say we sell an at the money put. So we sell the 635 for September for $877, and then we go and we go to October, and we'll go 10 wide. We'll buy the 645 for net $722 debit. Go to our risk profile. So this is what our risk profile looks like. Losses is the debit paid to the upside, $700. Remember, this trade is in conjunction with another with the rest of your portfolio. So presumably the rest of your portfolio is long. And I can make another video talking about like overall portfolio positioning, because your trade, it's kind of like making a cake. Like all your trades are like the ingredients to your cake, to your overall portfolio. This is just a ingredient. It's just a strategy that's not really talked about because it's really not that fancy. But what it is it's a guaranteed profit to the downside all the way, $278, with max profit with the market closing in September 19th at your strike of 635 when that put expires worthless. That's your max profit. So hold on. So sorry, I had to do something with my dog. Now what happens is, again, we're going back to the vol like we were talking about in the straddle video. The vol is very low here, and if the vol does expand, which means the market's going down, remember, market vol goes up when market goes down generally. So if vol expands here, we'll just go 10 points, right? Pretend it goes back to 23. Our now our profit here doesn't go up, but our max profit zone widens out quite a bit. It goes, say, from here 595 to like, say here basically 652, right? You make $500 in that range. Versus when you didn't have all that vol, it was a lot smaller. To make $500, it was just like basically this tiny ass window here of this crown. So your max profit range widens out, and you break even. Or you're not break even. Your max loss gets way higher. But theoretically, if vol's doing that, market's going down. So this is another play that you can capture a hedge to the downside, and when volatility expands, you have a very large window and it's theta positive, meaning that you benefit. So you watch the purple line, unlike the straddle where you lose to theta over time, this goes obviously right to the blue line. And so how you trade this is it's all based on your short put. So when the short put expires, then you can just sell your long put to close it, right? And just roll it and just redo it again. Now, what I was saying is you can skew this. You can completely reverse this trade and do this to the upside, which is okay, kind of weird because like it's more profitable to just go long like shares or something to the upside or leaps or something to the upside. So that's not really what this is intended for. This is more of a downside vol hedge. That's how I kind of look at it. You can move this dome, this like this mount, this peak of profit, because see, we're at the money here, so we're like to hit max profit, we need the market to go down a little bit. So if we just think that, and this is by September, it's August, it's a month. So if we just think that we're already at all-time highs, like we've talked about, and we're like, oh, maybe the market doesn't have that much more, maybe 650 is our number, we can just pin this at 650. So the dome is always going to be your short put. So if we roll our short put to 650 and then we take our long put and we go 10 or 5 above that to 660, now our dome is to 650. Or you can go to oops, that's the short put. Oh, to 660. Yeah, okay. You see what I'm saying? 10-point difference. Or you can go 5 to here. But what that does is now on the downside you lose, so it kind of defeats the purpose of the trade in my opinion. So you can even go out to here. You're gonna get, this is 20-point wide now, larger debit, larger max risk, larger hedge to the downside, and not that the vol doesn't do you as good, kinda, right? So I don't think the juice is worth the squeeze with that personally. I like the 10 wides on these, so I would do the 660 because now we're sitting here, market rips down. I have a 143 hedge to the downside, so this is pretty good for smaller accounts. I got a lot of max loss if we keep going up, but if again, because this is important, because I'm probably going to get questions on this. This isn't meant to capture the upside. You should be long Palantir and Robinhood and Nvidia and Meta and Google. Like you should be long all those stocks that are ripping higher, making you way more than whatever you're going to lose on this trade. This is a hedge because you're looking, just like the straddle, you're looking for vol to blow out. Vol goes 10 points. This is what this trade does. Vol goes 20 points on something crazy. This is what this trade does. It gets fat. It's fat as fuck. Why is it fat? Because the long put blows up because you're long a put. So if it's going down, that put's blowing up. This one's blowing up too, but it's decaying, right? So you get fat. Look at your cone here. It's a very large cone at this point. Now you're up here. So it's a vol trade hedge to the downside. Okay. I'm going to keep this one short. I could rant more about it, but I think I should make a video soon on how to construct an overall portfolio. So that's my video on this one. Thanks.